Welcome to Module 2, where we transform you into financial detectives. Just as Sherlock Holmes could identify a person's profession by observing their hands, you'll learn to identify companies and industries by analyzing their financial statements. This skill is crucial whether you're an investor, consultant, banker, or executive. The ability to quickly decode your financial patterns will set you apart in any business role. So here's what we're working on mastering this week. Financial pattern recognition. Spot the fingerprints of industries in the financial ratios. Comprehensive ratio analysis. Move beyond simple numbers to extract real insights. Industry benchmarking. Understand what good performance looks like across sectors. And forecast sophistication. Learn to model uncertainty with confidence. Lastly, forecasting sophistication. Learn to model uncertainty with confidence. Strategic integration. Connect the numbers to competitive advantage. Every world-class analyst uses these exact skills. When Peloton's model collapsed in 2021, analysts didn't need a press release. The warning was already in the ratios. Their inventory was rising, asset turnover was falling, and their margins were tightening. The financials told the story first. By the end of this module, you'll be able to see those patterns and predict the story before the headlines break out. So let's start with the fun challenge. Here you see two companies, no names, just data. Company A has a 19% gross margin, asset turnover of 2.1, current ratio of 0.95, inventory days 89. That's the hallmark of a retailer: low margins, fast inventory movement, and efficient use of working capital. Company B has an 82% gross margin, asset turnover of 0.8, current ratio of 2.8, days sales outstanding 45 days, DSO. That's clearly technology or SaaS. High margin, low asset base, cash rich, fast receivables. This is what I mean by financial DNA. Each industry leaves a signature pattern. You just have to learn how to recognize it. Investment bankers and equity analysts do this every day. They can look at 10 ratios and tell you that's an airline or that's a luxury retailer. You're developing those same skills and that same superpower this week. So continuing on from the last slide, as I mentioned, every industry has its own financial DNA. The patterns in the financial statements reflect its business model, economics, and the competitive environment. So generally speaking, for retailers and consumer goods, they have low margins, generally 15 to 25%, and a high asset turnover. Think of Amazon or Costco. They win on volume, not margin. Amazon even achieves negative working capital. They get paid before they pay suppliers. Now, technology and software, they have high margins, 70 to 90%. They're very asset light, and they often have negative working capital. Microsoft and Google dominate here. Once they write the software, every new customer is almost pure profit. Utilities is another interesting area. They have enormous fixed assets, very predictable cash flows, and heavy regulation. Duke Energy is a perfect example of this. They're big, they're stable, and they are highly leveraged. Another category here is banking and financial services. They're profitability driven by interest spreads and credit quality. For example, JP Morgan Chase lives on the margin between deposit rates and lending rates, with regulators watching every move they make. If you learn these patterns, you're never going to look at a balance sheet the same way again. All right, so let's move past basic math and into interpretation. Ratios aren't just numbers, they're stories. So when we talk about profitability deep dive, gross margins Trends show pricing power. Operating leverage reveals scalability. If revenues grow 10%, but operating income grows 15%, you got fixed costs creating leverage. ROIC versus WACC tells you whether value is created or destroyed. And we have efficiency metrics. Working capital trends, they show cash control. Asset turnover reveals how effectively capital is used. Receivables quality warns of credit issues before the auditors do. And then financial health, coverage ratios, liquidity, and capital structure all predict risk. Netflix is a great example of this. Once fixed content costs are covered, every new subscriber drops almost entirely to profit. That's operating leverage in action. So don't just calculate ratios, tell the story behind them. Forecasting used to be easier. You could rely on trends, but now it's welcome to chaos. Between post-pandemic normalization, inflation swings, supply chain breakdowns, and AI disruption, old models simply don't hold. The goal today isn't to be perfectly right, it's to be flexible and adaptive. Here's how professionals handle it. They use scenario modeling. They create a base, bull, and bear cases, and then they assign the probabilities, the likelihood of each scenario. Rolling forecasts, that replaces static annual budgets with dynamic updates. Machine learning integration uses data-driven models to spot early patterns. And real-time adjustments tie your forecast to live market data and leading indicators. So for example, Chipotle's sales patterns flipped overnight. Urban stores fell while delivery exploded. Ford's chip shortages made factory forecasts useless. Forecasting today is about agility, not perfection. And the analysts who can adapt the fastest are the ones who thrive. Your case this week is the financial detective. You'll analyze financial statements for 8 companies, each from a different industry. No names, no hints, just numbers. Your mission is to match each company to its industry by reading financial fingerprints. So start with obvious patterns. Who has huge fixed assets? Who has high margins? Calculate full ratio sets using the Excel template. Validate your guesses with logic. Do the numbers make sense for that business model? And then cross-check with your industry knowledge. And this exercise will mirror what real analysts do in investment banking, consulting, and private equity, identifying industries and strategies by financial DNA alone. So let's look at a couple of real companies and see this detective work in action. Netflix in 2024. Their gross margin was around 43%, showing how they spread content costs over years. Free cash flow finally turned positive, the end of their cash burn phase. And then now is the big question, can they maintain their edge as competitors flood the market? Walmart 2024. Inventory days were down to 44. That's a supply chain efficiency powered by AI. E-commerce pressure hurt their margins, but improving ROIC showed strong execution. And they are the poster child for digital transformation done right. Lastly, Tesla 2024. Margins were under pressure due to price cuts. Negative working capital gives them cash flow strength. High CapEx means forecasting is tricky. It's a constant trade-off between scale and profitability. Each of these companies' financials tell a strategic story, and that's what you'll need to learn how to decode. You can't judge performance in isolation. What's great for one industry might be terrible for another. For example, utilities earn 6 to 8% ROIC, and that's excellent given their stability. software firms earn only 8% ROIC, they'd be in trouble. Walmart turns inventory 8.7 times a year. Okay, LVMH turns it 2 to 3 times, but LVMH earns 65% gross margins. So that's why benchmarking matters. Compare companies to the right peers and understand their unique performance metrics. When Intel's gross margin fell from 65% to 43%, analysts saw commoditization before it hit the headlines. Numbers reveal competitive dynamics if you know what good looks like. Professional forecasters think in terms of probabilities, not predictions. They build robust models, meaning they break revenue into drivers, units times price, subscribers times ARPU. They validate forecasts from top down and the bottom up, and they stress test everything. What if interest rates rise 200 basis points? The second thing they do is they handle uncertainty. They use scenario modeling, Monte Carlo simulations, and stress testing. They apply real options thinking, and so flexibility has value. And lastly, they adjust for today's environment. Model inflation by cost type. They factor in ESG and regulation. They account for supply chain disruptions. Netflix's subscriber growth forecast now requires multiple variables: market saturation, content spend, and competition. Simple trend lines just don't cut it anymore. In modern forecasting, agility beats precision. Your Excel template this week is designed for professional level efficiency. It includes automated ratio calculations, industry benchmarking dashboards, forecasting frameworks, error checking tools. Here's a few best practices. Always document assumptions. In the future, you won't remember why you used 3% growth. So document that. Use sensitivity tables and conditional formatting. Make those insights visual. Centralized assumptions on one tab. That's how pros build scalable models. In the real world, analysts juggle 10 to 15 company models simultaneously. The difference between 2 hours and 6 hours per model? Excel mastery. In this week's discussion, you're asked to compare forecasting in cyclical versus non-cyclical industries. Cyclical sectors like auto and construction live and die by economic cycles. Forecasting them post-pandemic is tricky because old demand patterns broke. Non-cyclical sectors like healthcare and utilities, they used to feel safe. Now telehealth and renewables are rewriting their playbooks. If you're forecasting for new industries like Tesla Energy or Apple's VR products, you won't really have any history, so you'll use analogs and scenarios instead. Your discussion post should use real examples, 2024 or newer, and show professional level reasoning, not just those textbook type answers. So let's recap the biggest takeaways. Every industry has a financial fingerprint. Learn to recognize it. Ratios are stories, not just calculations. Scenario-based forecasting beats single-point guesses. Excel proficiency multiplies your analytical power. Integrate numbers with strategic logic. That's where the real insight lives. These are lifelong skills, whether you're advising clients, evaluating competitors, or managing your own company. Your ability to interpret financial patterns is what sets you apart. You have a competitive advantage. The skills you learn today, pattern recognition, sophisticated ratio analysis, industry benchmarking, and advanced forecasting, These separate excellent financial professionals from average ones. They're not just tools for passing a case study. They're the foundation for decades of a career success. All right, you are ready to go with it. Your path forward here, you've been equipped with Comprehensive Financial Detective Toolkit, pattern recognition frameworks, advanced ratio analysis techniques, industry benchmarking standards, sophisticated forecasting methods, and the professional Excel templates. More importantly, you understand the strategic thinking that connects numbers to business reality. I hope you enjoy this case study.